name's Liebenberg. I'm the Chief Executive Officer of Yellow Cake. Just turning to the disclaimer slide, it's an important part of our presentation. We're not going to have time to go through it here, but we have a copy of this presentation on our website. It was put up this morning. Let me just talk a bit about Yellow Cake. Yellow Cake was established to provide investors with pure exposure to the uranium commodity. It's not a commodity that investors can easily access exposure to. So Yellow Cake was established to do that. When we established Yellow Cake, it was against the context of supply-demand fundamentals, which pointed to a need for higher uranium prices. So Yellow Cake stores and holds physical uranium. We do that in regulated storage facilities. We don't have any mining resources, so we don't have exposure to mining risks, geological risks, or processing risks. And we don't speculate on the underlying uranium price. So what we do is we buy and hold uranium, and the purpose is to give investors the ability to take a price view via our share price. Because we're essentially like an ETF, a physically backed ETF, but in a corporate vehicle, keeping the costs low is an important part of the strategy. So we have outsourced a number of our transactional activities to specialist service providers like the accounting, IT, secretarial. I mean, in essence, we've got 2 employees, myself and the CFO. We're Jersey registered, we don't have a London office, and we have a non-executive board. So it's a pretty skinny structure. The other key component of this entity is the ability to grow. And we have a contract with Kazatomprom, which is the world's largest and lowest cost producer of uranium. What this contract allows us to do is to purchase up to $100 million of uranium through to 2027. It was a 10-year framework agreement that we set up in 2018. So we can buy up to $100 million of uranium per year at the spot price at our option. So we can do all of it or none of it, or in multiple tranches. And we believe this contract is particularly important as the supply side tightens. The spot market is not particularly deep and liquid, so trying to purchase that sort of volume of uranium in the spot market would most certainly move the spot price. As I mentioned, we store our uranium in 2 facilities. There are 3 regulated storage facilities in the West. There's one in the US, one in Canada, and one in France. We have about 8.7 million pounds of uranium stored at the facility in Cameco. That was the first storage facility we set up, and it's where most of our uranium is held. We recently set up a second account at the Orano facility in France, and we hold about 600,000 pounds of uranium there. And the reason we did that is, A, to diversify, but also it gives us the opportunity to take advantage of price differentials at the 2 locations. And we did that recently, where we swapped 500,000 pounds of uranium at the Cameco facility for material at the Orano facility, and we earned a fee of $1 million. So that was pretty good. Just quickly talking through the history, we IPO'd in July 2018. We raised $200 million. We spent $170 million on the initial uranium purchase of 8.1 million pounds. In August of that year, we bought another 350,000 pounds. In April of last year, we raised $34 million and bought another $30 million worth of uranium. That was 1.175 million pounds. In January of this year, we had seen our share price trade at a significant discount to net asset value for quite some time. So we launched a small $2 million share buyback. And then later through in July, particularly through the pandemic, the initial pandemic period of March and April, we saw our net asset value discount blow out significantly to a point where it was north of 30%. So in July, we sold 300,000 pounds of uranium, raised $10 million, and we put that to an enlarged share buyback. So at the moment, we hold 9.3 million pounds of uranium, and that was purchased at a price of $21.71. And today the spot price is just a little under $30. So, it's been a good investment for us to date. If we look at our balance sheet, the only assets we hold are uranium and cash. So it's a fairly simple balance sheet, but it's not that easy to understand because the shares trade in pounds, the assets are valued in dollars, and recently the share buybacks that I mentioned have complicated the cash and the shares in issue number. So here on this slide, and again, it is on our website, we've set out quite clearly the net asset value and the net asset value calculation. And as of last Friday, we were trading at a 23% discount to net asset value, which again, I find it hard to understand given that our balance sheet is really uranium, which is near cash and cash. If I just move to the industry context now, I mentioned the supply and demand. Uranium is seen as a reliable baseload supply of electricity, and we saw this during the period of the pandemic. The nuclear plants did operate 24/7 and were the backbone of many of the grids. Nuclear power is also increasingly being recognized as a contributing technology to a low carbon future. We are bullish about the demand side, and that is because of the build program that we are seeing in Asia and the Middle East. On the supply side, we have had an extended period of low prices, and that has led to supply cuts by producers, but also it has meant that very little investment has gone into new supply, which will be needed in due course. The supply side is very concentrated. 4 countries account for about 75% of global production. And during the pandemic, 3 of those countries were impacted, and we saw about 40% of supply being impacted in a very, very short space of time. So, we've got a concentrated supply side, we've got a very distributed demand side, and that makes for an interesting supply-demand dynamic. I'll turn a bit further now to the demand side. On the demand side, we've got 441 operable reactors in 31 countries around the world. There are currently 53 reactors under construction. In the last 8 years, 50 reactors were added to the grid. If you look at China, which is the biggest build program, they are looking to treble the size of their nuclear fleet by the early 2030s, and they will surpass the US, which currently has the biggest reactor fleet. China is looking to build about 5 to 8 reactors a year, so it's a significant build program. And also, we are seeing more and more countries adopt the 2050 carbon neutral policies. Recently seen Japan, South Korea, Netherlands is looking at nuclear. So all in all, demand, a steady demand picture. Small modular reactors is a new and emerging market sector. These reactors are typically less than 300 megawatts. They are single stage, they're more flexible than larger reactors, and because they are simpler and can be built in factories and put together on site, they should become cheaper on a cost per megawatt basis. The large reactors today are pretty much all built on site, so big upfront capital costs. These reactors are ideal for smaller grids and remote locations. Back end of last year, we saw the Russians install an SMR on a ship and connected it to a remote town in the northern Arctic. And basically, since the beginning of this year, that SMR has been supplying a population of 100,000 people with electricity. Significant investment is going into SMRs from national governments. We're seeing China, the US, the UK, Canada, all putting money into this technology, and significant companies here in the UK, Rolls-Royce, are putting a lot of investment into the technology. In the US, it's GE and a joint venture with Hitachi, and even the likes of Bill Gates getting involved into this space. There are currently more than 70 designs being worked on, and I do believe that we will see commercial SMRs in the 5 to 10 year time horizon. A key feature of this industry is long-term contracts. About 85% of utility fuel supply is contracted under long-term contracts. And that is because fuel supply is vitally important for a nuclear reactor. It cannot run out of fuel, because that would be a disaster. So fuel security is vital. We have seen lower contracting over the recent past, and if you look forward to 2024, US utilities are less than 50% covered, and that typically isn't the case. So we do expect the US utilities in particular, and later the European utilities, to come back in the contracting market. If I look at the supply side, if you take today's spot price, about 50% of global production wouldn't make money. And the only reason these companies are still producing is because of these long-term contracts that I mentioned on the previous slide. Most of these contracts were set at much higher prices. So in effect, producers have a hedge against the current spot price. But as those contracts roll off, producers will either face the spot price or will have to shut in production. And we've seen that happen since 2016. We have seen significant supply cuts, and from the two major producers, Cameco and Kazatomprom. In 2016, about 160 million pounds of uranium was produced. Last year, that was down at 140 million pounds. A similar number was forecast for this year, but due to COVID-19 and the impact on the supply side, we are likely to see another 20 million pounds lost out of the market this year. So supply is likely to be around 120 million pounds, and that is against global reactor burn of about 180 million pounds. So today we do have a supply gap, and unless we have higher prices and more investment going into this industry, we will have a supply crunch looming. Just to wrap up, Yellowcake provides investors with exposure to the uranium price without any technical or operating risks. We have set it up as a low-cost structure, and we have the ability to grow the vehicle through our contract with Kazatomprom. The market dynamics look attractive, demand is bullish, supply is struggling and challenged, and with very little investment into future supply, which will be needed in due course because mines are depleting assets. I talked about the contracting which needs to take place, and we are starting to see evidence of utilities looking at the long-term contract market. There were a number of US policy issues which have been settled in the last 2 years or so. So that should give US utilities a lot more certainty. And we do expect that when they do return to the contracting market, it will have a follow-on impact on the spot market. Generally in this industry, the term contract market drives the spot market. So thank you. That's the end of the presentation.
Okay, we've got some really good questions here. If you can hear me, I'm just going to read them out as they are. So I might jump around a little bit from subject matter to subject matter. First up, what are your annual costs to run the company as a percentage of the asset value?
Yeah, so we target a cost base of less than 1% of our net asset value. Our cost base is around $2.5 to $3 million a year, and this year it'll be less than that because we undertook the swap contract where we earned $1 million of fees. But our target is to be at or less than 1% of net asset value as leakage on an annual basis.
And same questionnaire, assuming the uranium oxide spot price continues to increase in the next few years, are you planning to gradually sell your entire holding? What's the longer term plans, or what will be the plans for the company after that?
So our strategy is a long-term buy and hold. I don't want to take any trading decisions which undo the commodity price views of our investors. Having said that, commodities are cyclical. What we convinced ourselves of is that when we set this company up, we were at the bottom part of the cycle. At some point in time, we may be at the top of the cycle, hopefully. And at that point in time, I guess investors may take the view that there's more likelihood of the commodity price falling. And probably what we'll see is a persistent discount of our shares to net asset value. The options we have at that point in time is to sell uranium and buy back stock. we could become a virtual producer and in effect sell our entire holding to utility, because ultimately all the commodity that we own gets utilized mostly in the nuclear fuel industry, the nuclear power industry. It's not like gold where it can sit in a vault. This product does get consumed. So we've seen situations in the past when there've been mine supply events and there's been a shortage of supply. Because the material we hold is already produced and without risk, it's not inconceivable that someone may want to take us out simply to get access to the material.
Thank you. Next question. Would Yellowcake need an EGM to authorize any further buybacks?
So we have a standing item on our AGM agenda where we seek approval from shareholders on an annual basis to buy up to 10% of the stock. So if we wanted to exceed that in any particular year, we would need an EGM. But at each AGM, we seek shareholder approval to give us that opportunity of up to 10%. We haven't utilized that at the moment. I think we've bought back about 4 million shares out of a total of 87 million shares. But that's the annual request we put to shareholders. Outside of that, we would need an EGM.
Next up, if I buy into the uranium bull case, then why not buy the miners instead of Yellowcake?
I think that's an interesting question, and it really comes down to risk reward. I would argue that when you're at the bottom part of the turning of a commodity cycle, what we offer is one-to-one leverage. You're not going to lose your money because we're physically backed. The material we own has value. If you bought into a development project, it may not get the permit, or if you bought into a miner, there may be other technical risks associated with that. So, as the cycle takes hold, you're probably going to get 3-4 times leverage from producers or development companies. But I think that's a risk reward trade-off. So I would argue at the turning point of a commodity cycle, we would offer a lower reward, but a lower risk. And just to bear in mind, because of the long-term contracts that I mentioned, that's very typical of this industry. If you buy a miner, and they've got a long-term contract book, you may not get full exposure to the price upside. So if a miner had 60% of its production covered under forward contracts, you'd only be exposed to the spot price through the residual 40% of their production.
Are more reactors being completed rather than closing in the next 5 years? What is it?
Yes. So there's if you look at the WNA statistics, they're forecasting about between 1.5% to 2% growth per annum through to 2040 in terms of capacity. Generally, the reactors that are closing are smaller units, older units. But interestingly, in the US, we've seen life extensions being given to nuclear reactors because of the function they perform there. So originally, these reactors were built to 40-year lives. We've seen life extensions to 60, and more recently, there have been life extensions through to 80 years. Also, the newer reactors that are being built are larger, generally 1 gigawatt or 1.4 gigawatts. So net, we're expecting to see growth. But that growth won't come in the West or in the developed economies. It'll generally come in the developing economies. The US reactor fleet, currently about 95, 96 units, probably lose a few, down to maybe 90, but not much beyond that. But the growth will be in China, India, and the Middle East.
I saw today there was an article on the BBC website about the mini reactors and Rolls-Royce's interest there. We've had a question about mini reactors. The presumption being, would they be subject to the same permitting regimes as full-scale reactors?
Well, interesting, because right now, certainly in the US and in other countries, the regulators are looking at how to regulate, and permit those sorts of reactors. I think, the very simple answer is if you wanted to put a SMR on a current facility, it's already permitted. It's got the infrastructure. I mean, these SMRs are probably the size of a football field, so they don't take up a lot of physical space. But I think if you look at, particularly in Africa, where some of the, a lot of the countries, their electricity demand is not sufficient to back a 1 gigawatt or 1.4 gigawatt reactor. So these smaller reactors do have a role to play there. But on the other side is, how they're going to be regulated and permitted. So that is an issue. It is being looked at. Certainly, the countries that are looking at this technology are also looking at the regulation side of it.
I had a question about the discount, and you mentioned how it had gone wider and it had come back down again. But as you are physically asset backed, what is the rationale when you speak to investors? What's the rationale for that discount being there? What you can speak to that?
Well, we have a peer company in Canada that's traded on the TSX, and they're at a very similar discount to ourselves. So, for me, it's not a company specific issue. That their discount's slightly lower than ours, and I think you can argue that the Canadian market understands uranium, and certainly UPC have been around for 10 years, more so than the UK market probably understands uranium and yellowcake. So I would think, I have to think that it's an industry perception issue. The uranium price went from $24 pre-COVID through to $34, and has steadily drifted back to around $30. So, perhaps there's a perception that a lot of idle capacity will come back on, and the uranium price will drift back to 24. So the net asset value could close that way. We don't believe that. We don't see that happening, and we are seeing quite a lot of support for the uranium price where it is now. But so I would have to point to the fact that it's probably an investor perception of where the underlying commodity price is going versus our share price.
And you showed in one of the graphs the supply cuts. How quickly can supply cuts be ramped back up again if there is demand or the price supports it?
Yeah, it depends on the type of operation. So Cameco shut in McArthur River back in 2017, and then they put it on care and maintenance in 2018. The estimates are for that mine to come back on stream, it could be 18 months, plus or minus. So a fairly extended period. In Kazakhstan, they have cut back on their well field development. Their mining method is an in situ leach recovery. So, wells are drilled, acid is poured into the wells, and the mineral is extracted at the other end. And typically the lag between well development and actually getting the material can be between 6 and 8 months. So, the cutbacks they have done there, we're probably only going to see the production impacts in the next quarter or two. And they've started their well development again, so you'll only see the benefit of that in probably 6 to 8 months' time.
Okay, and last question we've had here. We've heard the bull case for uranium for what feels like quite a long time now, and it predicted demand supply mismatch. It hasn't really happened. It feels like it hasn't really happened. And people's expectations. Why is that? And why now is that going to change?
Maybe I should have put the title as the presentation. The bull case remains, but it's taken longer than we thought. It's a good question. I think part of it has been the policy issues that we've seen. There was the Section 232 investigation in the US that ran through to April of last year. Then President Trump put in place the Nuclear Fuel Working Group. We saw the Iran sanction waivers. We saw the Russian suspension agreement. So all of those policy issues, really caused the US utilities not to want to enter the contracting market because they didn't know what the rules of the game were going to be. The US imports about 20% of its enriched uranium from Russia. Was that going to be zero, or was it going to be kept at 20? the Iran sanction waivers, were the companies that were building the nuclear plant in Iran, were they going to be sanctioned and therefore not allowed to participate in the US? And then the whole working group looking at US production. So all of those things have been around for the last 2 years. They've, pretty much been settled now. The Russian suspension agreement was agreed early October. So hopefully that is out of the way. Also, I think, we had an oversupplied spot market, and there are a number of entities that, provided midterm contracts for producers. They would buy in the spot market, turn it into a 2 or 3 year contract and sell it to utilities. So as the contracts fell off, utilities weren't too concerned because they could get access to this midterm market. But as we flipped into an undersupplied market, I think that's going to be harder to do. So a number of reasons. I don't think the underlying premise of supply and demand has changed, but yes, it has taken longer than we thought it would.
Okay, Andre, that's terrific. Thank you very much indeed for joining us this evening.